The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
It's Friday afternoon, and we're going to be talking about money. Howard Marks was an investor and writer, and he has a quote that I like a great deal. He said, "You can't predict, but you can prepare." And if there's anything this show is about, it's about that. Not predicting, but preparing for what's coming. You know, we are now 7 years into this secular bull market. People talked about the market crashing. They talked about the double dip. They talked about all sorts of things in the past years. But we're now 7 years into a secular bull market. Where are we going? And how will it end? I have those thoughts today. I have an approach from a mile-high view of where we are today and where we're headed. So you're going to have to listen to me all day to get the whole picture. But here we go. But before we get there, you know, commodities have busted. They're down, they're cheap, but there's one beneficiary of that. Actually, there's a lot of beneficiaries, but one specific beneficiary that I've been thinking about is the U.S. Mint. Because the U.S. Mint makes coins. And a nickel coin used to cost them 8 cents to make because it was 75% copper, 25% metallic nickel, and every nickel they produced cost them 8 cents. Now, a lot of people are not surprised that the government will make something that they sell for 5 cents and it cost them 8 cents to make, but that's another whole story. Now, with commodity prices down where they are, it only costs us 3 cents to make a nickel. That's not bad. I mean, they used to do it in quantity. That's how they used to do it. Now they're making a profit. Anyway, I want to come back to this thing. You can't predict, but you can prepare. And today I want to take the mile-high view and start from where we are, where we're headed, and how this secular bull market will end. Because I do believe it's going to end, and I think that you can prepare for it. Not now, maybe not for a couple of years, but it's time to think about where we're headed and when we'll go. So Standard Chartered Bank, I've talked about this any number of times. Standard Chartered Bank out of the UK, 1,700 branches, 80,000 employees. They did a report which received a lot of viewers back 6 or 8 years ago. Actually, it's been 8 years ago. And they talked about super cycles. They did a study and looked at world GDP and what had happened to world GDP over long periods of time. And they found that there were 2 previous super cycles. The first super cycle was what they identified in 1870 to 1913, a period of 43 years when the world GDP grew at a much faster than average rate. And it was driven primarily by the industrialization of the United States. Think about it. The Model T Ford came along, the assembly lines. The railroads grew during that period of time. We moved freight back and forth. We moved product back and forth across the country. The telephone and the telegraph. Actually, the telegraph came first and then the telephone. That happened. The steam engine was developed during that time, and internal combustion engines. We had the development of steel, and Hall developed the process for making aluminum in this country, aluminum in France, and you built an industry that was built around steel, around aluminum, about heavy metals. You had the advent of making electricity in significant quantities. And one of the things which most people don't think about is clean water. That had an enormous impact. during that period of time. It increased longevity and it increased health throughout the country and through those nations where they were able to have and access clean water. It was a time of pretty powerful growth worldwide, but it was also a time in which the United States experienced some financial crisis. It was an adjustment period of time. In 1870s, we were an agricultural nation. Over half the people worked on the farms. And by the end of that period of time, we had converted to an industrial country. But unemployment during that time ran at close to 20%. It was a very difficult time as people moved from the farms into the cities. It was a time in which there were 6 periods like 2008. Every other year was a recessionary year. It was a tough time. It was tough for certain industries. Cotton. If you look at the number of millionaires in the United States during that time prior to the 1870s, over half the millionaires in the country, they lived on the Mississippi River and they raised cotton. That was to change dramatically. The United States was emerging as a world leader, and while London was, at that time, the financial capital of the world, that was beginning to shift, and that would continue to shift. The first cycle came to an end in 1913 and was followed by a slower period of growth. But in 1945 to 1970, you had a second super cycle that took place, 35 years. These are not short periods of time. It was driven by the rebuilding of Europe. World War II was over. You had to rebuild Europe. You had to rebuild Japan. You had to rebuild a lot of Asia. There was a lot of rebuilding that was done. It was relatively benign. You didn't have the tough time you did in the 1870s. But you had a growth in wealthy countries, the U.S. and the UK and France and Germany. You had a stock market that the Dow went from 150 to 1,000 during that period of time. But you also had the death of the colonial system. You had those colonies in Africa and Asia that came apart. You had the rise of the Cold War, competition between the U.S. and the USSR over the former colonial nations. And you had consumer growth. We had the advent of fast food, the advent of TV, of two-car families, the 40-hour work week, of vacations. You had a huge increase in housing through the GI Bill and education. You had a huge building of the interstate highway system and infrastructure. And of course, by the beginning of the 70s, by the end of the 60s and beginning of the 70s, we had the beginning of computerization. That was the second supercycle. There's a new supercycle that Standard Chartered Bank said, and I completely agree with, that began in 2009. And it's going to be driven by the emerging nations, especially Asia. The winners are going to be those companies which are global companies. They're companies that understand that their market is no longer limited by geography, but they're going to expand internationally. And you're going to have the rise of a middle class. By 2030, the prediction is, and we're not that far away, we're less than 15 years away, by 2030, the estimate is that 93% of the world's middle class will live in what we call the emerging nations. China and India and Brazil and Indonesia, Russia and Turkey, Sub-Saharan Africa, all of those countries are having GDPs that are growing significantly higher than that of the average world GDP. You think about it. People talk about China slowing down to only grow at 7% per year. We're growing at 2%. Europe is growing at less than 1%. Those emerging countries are growing, and they're moving. There was a time in which we used to move labor over to China for the low labor rates. Those things are changing. We're seeing people move from subsistence, where they barely get by, to buying and consuming American products and world-produced products. They're actually consumers, and that's the beginning of middle class. It's a wide range, just as it is in the United States. If you look at the middle class, there's a very broad range. But what we're seeing is those people in those emerging nations are becoming consumers. They're becoming consumers of our products, and we're as we are consumers of the products they produce. And every supercycle has its losses and its gainers. In the first supercycle, it was agriculture. In this supercycle, we're going to see some companies that don't continue, but we're also going to see a lot of other things that happen. We're going to see countries which are less transparent, that are less stable, where investment can be more vulnerable and subject to politicians and bureaucracies. Corruption can be epidemic. We're going to see a fundamental shift in the balance of power. That's going on now, and that's driving the supercycle. We're not done with the supercycle. We're going through an adjustment period that I've talked about, and I'm going to continue to talk about once we come back from this break. So if you have any questions about what you hear on this show, you can tweet us at About Money Radio, and we'll try to answer either on the radio or as we come back. So don't go away. We're going to be right back after this commercial break. We're going to finish this supercycle talk.
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our clients' interests first in all portfolio decisions.
If you're looking for a home for your seven-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
Seattle.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I've been talking about a mile-high view of where we are. We're 7 years into a secular bull market. Where we are now, what's happening, where we're going, how it's going to end. That's coming. I have a great guest today, too. We're going to be talking about some of the things which really fit this whole thing of the supercycle. Because the supercycle is something that, as I mentioned before, I mentioned at the beginning of the program, times in which world GDP grew at a faster rate than average. The first supercycle from 1870 to 1913, driven by the industrialization of the United States. The second supercycle from 1945 to 1970, driven by the rebuilding of Europe and the decolonization of Africa and Asia. The third supercycle has begun in 2009. We're seeing it. We're 7 years into it. It's the emergence of the emerging nations and the shift of middle class. 93% of the middle class will live in those emerging nations. China already has a middle class that's larger than the population of the U.S. India will be there soon. We're seeing that happen, and those people are moving from subsistence to consumers, and they're going to consume our products. We're going to consume theirs, and it's going to shift the wealth curve up. It's not a zero-sum game. It's not that they'll win and we'll lose. It's a game in which everything is raised up. And yes, Their economies are going to grow faster than ours, but ours will continue to grow as all. It's not a one-size-fits-all. It is a time in which I believe we haven't seen, and we're not close to the end of it. If you look at these long periods of time, the first one was 43 years, the other one was 35 years, and this may be less than 30 years, but it's going to continue to go on. If you look at the last secular bull market, it went from 1982 to 2000, 18 years long. We're just 7 years into this. Yeah, we're going to have some setbacks. So did they in the last secular bull market. They had the October 19th, 1987 drop. They had the 1991 drop. They had the 89 drop. We have those periods of time that come along, and we're seeing one of those times now where we're seeing part of the economy that's struggling. But I've talked for over 6 years now about Dow 100,000. We're getting closer. We're closer today than when we first started talking about it. It may seem like an enormous amount for things to grow. But I remember I was in the business when the Dow was 1,700. I remember talking to someone that was a potential client. He was waiting for the Dow to get back to 1,300. It never did. Probably never will. 1,300. He was so convinced it was going to come back to 1,300. He wanted to sit in cash to buy at that price. Never got there. Even with October 19th, 97, it never got there. So for those people who are looking for things to drop down from here, some things, some industries will drop down. Some of the parts of the market will drop down. But I believe we're on our way to 100,000 and maybe more than 100,000. That looks a lot closer when the market is 17,005 or 18,000 than it did when the market was 8,000. It's going to get there. And it's going to be a time in which wealth is built. But it's going to be a time as well when the world is changing. Globalization is changing. We're going through a time. Friedman wrote a book called That Used to Be Us, and he talks about some of the challenges. I believe those challenges exist. We're going to see those. We're sitting in the midst of a IT revolution, information technology. It's changing the whole world. You know, that is happening. Jobs are being eliminated and jobs are being created. More jobs are actually being created, but we'll get to that later in the program when we talk about our guest. Whole new industries are developing. Even the jobs, they're becoming more complex. The ones that are routine are being eliminated. The IT revolution is here and it's happening. It's going to continue happening, and it's going to continue to accelerate what's going on. Energy and the environment. Emerging countries are faced with those things as well. They're growing, and as you grow, you consume more energy, and that creates problems in the atmosphere with global warming. We have to meet both of those challenges. And national debts and deficits. We've gone through a time when there was a lot of money available for a lot of things. Now it's becoming more and more an issue of prioritizing where money goes. From the national governments to local governments to state governments, there'll be more and more emphasis on prioritizing the spending of those governments. Those are issues that are going to be faced, but they're part of where we are. We have a momentum that's upward. Doesn't mean there won't be some downtimes, but the momentum is upward. And if I look at this from the mile high, we have some very, very good times to go through. Some setbacks, but some very good times as well. But it will come to an end. It will come to an end, and we will see, in my opinion, we'll begin to see that end happening. Just as people saw what was happening with the housing market and leading up to the Great Recession, seeing the things plunge down, and now there's a movie about it. There was a book written about it, The Big Short. There were people that made money from it because they saw it. I didn't see it. I knew we were going to go through a credit crunch, but I never saw the crisis. There's a lot of people who said they saw it. You know, if they saw it, they didn't see it until they saw it in the rearview mirror. But there will be, and one of the purposes of this program is to help you visualize and understand when that's happening and how to prepare for it. But that's coming. First, I want to introduce my new guest. My guest is the CEO of the Washington Technology Alliance, Michael Shutzler. Did I get that right?
You did.
Sometimes I don't. So welcome to the program.
Thank
Why don't
you.
we talk about your background?
Sure. Where do you want me to start?
Anywhere you'd like to start.
I spent 30 years of my life in the tech industry, an electrical engineer originally, and I've spent most of that time as an adult launching products in a number of different countries for a number of different industry sectors. For the last 2.5 years, I have been serving as the head of the Washington Tech Industry Association to serve all the 9,000 tech industry companies in the state of Washington.
So you mentioned 9,000 tech companies in the state of Washington.
Yep. Most people don't know that number.
It's a huge, huge number.
It is.
I remember in the 1980s, it was 700 software companies.
Come a long way since then.
You know, a long, long way.
Yeah.
So tell us a little bit about the association.
Sure. The association has been in business now for 30 years, serving this sector. We principally focus our efforts on serving the largest dilemma that faces the entire tech industry, which is that we create jobs roughly 10 times faster than we can produce talent locally to take those jobs, which makes us the #1 recruiter of talent in the country. So our association is focused on that particular dilemma in 3 areas. We help recruit talent to the region, we help develop talent in the region, and then we help companies retain the talent that they grow or recruit to their ranks in order to help them grow.
Let's talk first of all, about the impact of what happens when there's a job created and what the impact on the economy is, because it's not just one job that's created. It may be a job that's eliminated, but it creates as well.
Well, actually, the tech industry as a whole is a net job generator for the entire state. The easiest way to explain this is that one software developer creates 7 non-technical jobs. And the easiest way to really visualize this is if you and I were sitting in our dorm room or sitting in our garage and we invent a new application which we run on our smartphone. The 2 of us are serving as the software developers. We code that. As soon as that thing goes live, if we have any success with that product at all, we're going to need to hire accountants to count the money that we're making. We're going to need salespeople to help sell it. We're going to need marketing people to promote it. We're going to need all sorts of folks working in our small company to help us build this product into a large company. Each of one of us is working in a highly profitable industry, so we're all making a good salary, and we're out buying cars, buying houses, eating at restaurants. Our kids are, taking soccer lessons or ballet lessons or whatever, and each one of those expenditures is producing jobs outside of our company that are also non-technical. So literally one software developer job in the state of Washington creates 7 other jobs, which is why our industry, as an impact to the whole region, has created 2 out of every 3 jobs in the state of Washington for 20 years going.
It's the old thing of the butcher pays the baker, pays the candlestick maker.
You got it.
But it creates 1 out of how many jobs?
We have created 2 out of the 3 jobs over the last 20 years in this state.
That's pretty incredible.
67% of the jobs are coming as a result of the tech industry in our state. Yeah.
And it's transforming places like Seattle. When you look at South Lake Union, it's being transformed.
It is. And, some would argue that that's problematic because if you have a lot of rapid change, it's hard to digest. Another way of looking at it is realizing that Mark Andreessen said software ate the world, and I'd love to tell you about that.
We're going to come back and hear about that right after this commercial break. Don't go away. We've got more to talk about. Sorry.
No worries. You got it.
More
They cut
About
us
Money
off.
coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
Talking about the Washington Tech Association, which he is the CEO of, and we're talking about the jobs and the job creation and the impact it has. You know, we started to talk a little bit about South Lake Union, but
I think that to me, one of the most interesting things about the impact of the tech industry in our region isn't just the thing we were talking about where one software developer job creates all of these other jobs around it, which has a really positive impact on the community in terms of job creation and, of course, revenue for the state as well for everything from schools to roads and bridges. One of the other things that is often misunderstood is that this software impact on the world is really significant even inside of non-tech companies. There are more software developers working inside of Starbucks than there are in almost all the software companies in the city of Seattle. Mm-hmm. There's thousands of developers. And in fact, the most ubiquitous, successful smartphone application for point of sale is the smartphone app that Starbucks uses to buy coffee in the morning. So it's really, the software has really had a significant impact on just about every aspect of our lives in a very positive way as an economy.
And from the car keys that we have to the music we download to the TV that we stream, I mean, it's a changing world.
Right.
So when we talk about the software developers mm-hmm. and finding the right kind of people, I've heard the term used, full stack. What does that mean?
A full stack developer is someone that is skilled at software from the very top level. So if we take a look at your smartphone, the screen has got pictures and icons and things that you interact with that are visual. That level is called the presentation layer. Every layer beyond that, so that's actually driven by some software that does some computation, and that computation is done on a device, and that device connects to the internet, and the internet connects to other devices and connects to databases. All of those are, if you can imagine, a sort of stack of layers going all the way down to the actual device, which talks in ones and zeros. A full stack developer can handle everything from the bottom to the top.
And is that the kind of person that the software companies are seeking?
Well, software companies are seeking literally every kind of job imaginable. If you are a good accountant, we probably need to hire you. If you're really good at customer service, actually, the number one difficult job to fill right now, ironically, is salespeople in the technical field. The most difficult to fill technical job at the moment is a full stack developer. It's very difficult to get people that have the skill set and the experience to do that job. It's less difficult, for example, to find people who are capable of doing the basic coding involved in building a website in WordPress, for example. But full stack developer is definitely one of the top demand and top difficult to fill jobs.
And so where are the people coming from? You mentioned that there's a large shortage of jobs. I've heard the figure before of 25 or 28,000 jobs that are needed, and we're producing 600 people or whatever.
Yeah, so there's quite a bit of confusing, even I wouldn't call it misinformation, but just confused information about this. So this 28,000 number is referring to the number of jobs in the tech industry that have been open for at least 6 months without finding a qualified candidate. And that number has been growing at about 6% per year for the last 7-8 years. So at the rate we're going, we're expecting that number to be more like 50,000 open positions in just a handful of years from now. When it comes to full stack developers or people that are software developers that have the computer science background to do the more challenging jobs, we create about 4,000 to 5,000 of those jobs every year, and the state's entire output is about 500 students a year that graduate. So that means that we're looking around the country for another 4,500 people.
And so where do they come from? Is it just in this country, or are we looking outside the country as well?
Well, first and foremost, we look in this country because it's easier to recruit. It's easier to relocate from California than it is, for example, from China or Czechoslovakia. And we will take, this industry is pretty agnostic. We'll take whatever we can find as long as you're capable of doing the job. So it's easier to recruit from the U.S. And of course, we recruit from Utah. We recruit from California, Maryland, Massachusetts, Texas. Those are we're all some of the most successful schools, school programs are. So we recruit there. And of course, we do, recruit from other parts of the world. But we're limited by H-1B visas. There's about 125,000 a year that the industry as a whole can hire, and that's far short from that. And that has to serve the whole country. Most of those visas are applied for and awarded within about 24 hours. Mm-hmm. And so the supply-demand gap is pretty significant there. Most of the recruiting in this state's done from other states.
So how do we compare to places like Silicon Valley or Austin or Boston, some of those places which are also developing software?
Sure. We have all the tech centers in the country, so Research Triangle Park, the Boston cluster, Austin, Texas, Silicon Valley, they all have a supply-demand gap. We have a pretty gigantic supply-demand gap here because the state as a whole has, some would say, grotesquely underinvested in public education. We don't have a large private institutional network here. Our entire state production is through state school systems, which have been underinvested in. Whereas if you compare us to some of the other states that we're talking about, they've done a much better job of investing. And they also have, in many cases, private institutions that supply that pipeline as well. When it comes to actual headcount, most people don't know this. We have more software developers in the Seattle metro area than they do in San Francisco. We've done a very, very good job of recruiting people to this area that are skilled in software development, making us the center of the universe when it comes to software development.
Is that right?
Yeah. Most people don't know that.
Most people don't. Most people think of Silicon Valley as being the center of software development.
That's because most of the venture capital on planet Earth investing into the tech industry is in Silicon Valley. No doubt about that. And there's more bodies in general there, building companies and involved in the tech industry as a whole. Just it's a larger population. But in that specific job classification of software developer, we've got more here than they do down there.
Interesting. So there was an article in the paper today produced by a study group out of Austin, Texas, saying that gap between the number of jobs and the number of people to fill those jobs is shrinking. Mm-hmm. If you look at 2012, 2014.
Yeah.
Is that really right?
So there's a job classification problem that policy wonks and economists tend to get confused about. When you look up the data sets that these folks use to study this, they'll see the title computer programmer. They'll see software developer. They'll see application software developer. They'll see system software developer. And they won't know what to do with all of that. And so they munge it all together and just look at it one big fat average. If you look at computer programmer, that includes web developers. So there are more people graduating from code academies and community college programs capable of building a website than there are jobs for building a website. But The difficult to fill jobs where there's been no change in gap whatsoever is if you need someone to build a new search algorithm, you want someone to create a brand new system and software, that requires this full stack development skill set. And it almost always requires a computer science degree that's got a 4-year background on it and experience. The number of bodies available to do those jobs is not closing the gap at all. In fact, it's in the opposite direction. More jobs are being created than bodies to do those jobs. So depending on what you're looking at, you can. What did Mark Twain say? There are lies, there are damn lies, and there are statistics, right? So in this particular case, you really have to be very careful about what your definitions are, about what jobs are being filled and what jobs are not.
One more quick thing to finish off, and that's venture capital.
Yeah.
Because I've heard that said that there's really only one venture capital company that's really active in Seattle. Mm-hmm. So is it difficult for software companies to gain venture capital here?
Well, so first things first. There are about a dozen venture funds in the Seattle area. There's one that arguably is almost exclusively focused on investing in tech companies in the region, and that's Madrona. They're very actively focused, and there are many other funds here, but they have, generally speaking, a wider view of what it is that they're investing in. If you are a company worthy of a Series A term sheet from a venture capital firm, you're not going to have difficulty getting a Series A term sheet. Might not come from Seattle. It's probably going to come from the Valley or Chicago or Boston or someplace else. These days, even Chinese and Korean investors are coming here to the Seattle area to invest in. So if you got a company worthy of a Series A term sheet, you're going to get one.
Awesome. Thanks for being on the program.
Thanks
it's been really informative. Face a huge problem in bringing in the right number of people.
Yes.
But if you look around, we're doing a halfway decent job of it.
We're doing a very good job of recruiting. No question about that, Mike.
So let me shift. We're coming to a commercial break. If you like what you're hearing and what I have to say, we have a blog on adamsfinancialconcepts.com where I go into further depth on some of these talks, and you can hear more, you can see more than what I'm doing on the radio. You can also add us on Facebook, like us on Facebook. You can check us on Twitter at About Money. You can like me at Mike Adams AFC. Get blog updates, get news, get more. Check it out. adamsfinancialconcepts.com. Check the website.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
You know, Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our clients' interests first in all portfolio decisions.
If you're looking for a home for your 7-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
We're back with more About Money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So, I started the program by talking about the secular bull market. We've been in this market for 7 years now. It bottomed in March of 2009, and we've been seeing a triple in the market. I started the program by a quote from Howard Marks saying, "We cannot predict, but we can prepare." This bull market, I think, will continue to run for a number of years. But there will come a time when it comes to an end. Preparing too soon is the wrong thing to do. But being prepared and having the vision to begin to prepare as things change makes all sorts of sense. Think back to 2005, 2006. The movie is out, The Big Short. There was the book. There were those who saw a disaster coming, and I didn't, but they saw the disaster coming and they prepared for it, and they made a lot of money doing that. I believe that that's the reality, is that very few will see the end of the bull market. Most people did not see the end of the market, the bull market that happened in 1982 to 2000. People were thrilled with what was going on. People didn't prepare at all, seeing that the end was coming for that. Most people didn't prepare well for the Great Recession. What we have is a cycle. And I believe that there's a large cycle it's part of growing up. It's a part of a generation. If you look back, 1929 to the 1930s, the generation of young people that grew up during the Great Depression, that had a huge impact. My mother talked about that growing up at that time, and the things that they did during those times of the Great Depression, the stories. And the young people that grew up during the Great Depression, as they came into positions of power and positions of influence, when we hit a recession in the 1970s, they took actions to prevent a Great Recession or a Great Depression. And what they did, they were willing to inflate their way out of that recession, and we ended up with a great inflation. And not only an inflation, but a stagflation, where we had a growing economy and yet incredible inflation that was going on. And that generation that grew up at that time, during that inflationary time, when they achieved power, as they have in the past 10 years, they were willing to risk a Great Depression to stay away from inflating. You heard the words. You heard people talk only a few years ago about not printing money, not moving money into the markets, not allowing the Fed, not allowing the Treasury to print money because it was going to cause hyperinflation. Very, very many people were saying, oh my gosh, we're printing all this money, we're going to end up in a period of hyperinflation. Those people remembered the 1970s, and they didn't want to repeat that. We came through that period of time. We came through it better than most people expected. But I think the way we will see the end of the great bull market that we're in now is with a period of high inflation once again. The period, the generation that has grown up through the Great Recession as they achieve positions of power and influence will be willing to inflate their way out to avoid another Great Recession. So looking back, you know that I believe that history doesn't repeat, but that it rhymes. If you look back, inflation is like the story of the frog. You know, the frog in the boiling water. Drop a frog into boiling water, and it'll jump out. But if you put a frog in water and slowly heat it up, eventually the water boils and the frog never moves. Now, I've heard that story over and over again. I'm not sure that it's really true, but it makes a good picture. Anyway, if you look back what happened in the 1960s to the 1970s, that period of high inflation, a lot of the credit went to, or a lot of the blame, whatever you want to assign, went to OPEC and oil prices. But the data doesn't show that. In the 1950s, beginning in the 1960s, 1962, you had an inflation of 1%. 63, 64 were 1.3. 65, 1.6. Very, very gradual buildup. 1966, 2.9. long before we had OPEC and their oil crisis. 1967, 3.1, 1968, 4.2, 1969, 5.5, 1970, 5.7. And then we began to see a slowdown in the economy. That's not unusual either. Then 1971, we dropped to 4.4. The recession is taking place. In 1972, we dropped to 3.2, and then along comes OPEC. And in 1973, 6.1. In 1974, 11%. 9% in 75. We begin to put price controls and restrict some of the things, and we get inflation all the way down to 5.8. 1977 to 6.5, in 1978 to 7.6, and the price controls really don't work. And by 79, we're back to 11%. By 80, we're at 13. 1981, we're at 10. And 1982 at 6. And at that point, Jimmy Carter appoints Paul Volcker, who begins to raise interest rates. But during that period of time, we saw this inflation begin to take off and rage. At the same time, we saw growth in the economy. We saw stagflation. You know, if you look at where we are today, we've had a bust in commodities and wages have been stagnant. You hear that all the time. Wages are stagnant. It's part of the political campaign. Whether it's Republican or Democrat, they talk about wages being stagnant. Well, they're not quite as stagnant as people would have you believe. We've started to see wages pick up. Through February of 2016, the average wage in the last 12 months has increased 2.5%. It was only 1.6% for February of last year. And if you look at the impact as just of a rule of thumb, rule of thumbs are general, but inflation is driven 2/3 by increasing wages and 1/3 by increasing commodities. If you look at where commodities are today, commodities have taken a big hit. Wages have been stagnant, but with unemployment under 5%, wages are beginning to pick up steam. We're beginning to roll along. That will have an impact and begin to drive inflation. If you look at the inflation numbers today, they look low. But remember, what's happened with energy prices and with gas, that's a positive for the economy in the short term. In the long term, it's positive. It's a stimulus. But if those commodities are really beginning to grow, if you look at what's going on with oil, for example. Oil is growing, has a surplus of nearly 2 billion barrels a day. We're producing 96.5 and we're consuming 94.6. There's a surplus of 1.8. But if you look at overall growth, we're growing at just under 2 million barrels per day, per year. So by this time next year, we should be almost in balance with production and demand. We've got a lot of supply to consume, and that will come along. But my guess is this is the way the bull market ends.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on AdamsFinancialConcepts.com. That's AdamsFinancialConcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Friday afternoon at 3 for more About Money with Mike Adams, here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
The following